Assalamu alaikum to all of you, and a very good evening to the last day of the ACCA Practice to Pass session. I hope you guys are having have got this lots of benefits from these Practice to Pass webinars and the practice and the concepts that we have discussed in the last 4 days. So, if you evaluate your progress regarding the examination preparation, then you will find a substantial, I think there must be a substantial improvement in your preparation just before the session and after the session. And if you follow the plan that I will share on the group today, then definitely till the examination date, you will definitely pass this paper, inshallah. So it's good to hear from the students that they are getting the benefits. So I request all the students to give their uh, honest feedback about these sessions, because ACCA has organized these sessions free of cost to the students. So what's your recommendation, that ACCA should continue offering these sessions to the students free of the cost, or it should discontinue this type of sessions? My point of view is that it's a wonderful session that ACCA has organized for the students. So I think we all should be thankful to ACCA for supporting us and offering these sessions. So today we are going to start with one of the key accounting standard that is relevant for this session, that is IAS 33, earnings per share. IAS 33, earnings per share. IAS 33 says that you have to calculate two types of EPS. The first one is the basic EPS, and the second one is the diluted EPS according to IAS 33. And these two EPSs should be disclosed on the bottom of the income statement every year. So that the shareholder should know this, that on average how much amount the company is earning per share, and then they compare it with the previous years and the comparators, and in order to take the investment, to make the investment and take the relevant decisions. So ICLC says that you need to calculate two types of EPS. The basic EPS is based on the current level of shares, and diluted EPS is based on the assumption that if the future potential ordinary shares are being converted into ordinary shares, then that will be the impact on the EPS. So if I elaborate this in a very simple meaning, that you can say that basic EPS is the normal EPS of the company, and diluted EPS is the worst case scenario that you need to show to the shareholder. The formula that we follow to calculate the basic EPS will be profit after tax minus preference dividend minus NCI, if we are calculating the EPS of the group, divided by weighted average ordinary shares. This whole numerator is also called earnings. NCI, that is shown in the income statement. NCI acquisition or reporting is actually related to the balance sheet. So we are talking about the share of the profit of NCI in the current years from the current year's income statement. Yeah, NCI will be used only when we are calculating the EPS of a group. So when we are calculating the diluted EPS, the formula will be the same. In the numerator, we will be having earnings, and denominator will be having weighted average ordinary shares plus notional savings plus notional shares. That's the formula that we use for the calculation of earnings per share. So right now we are going to start with the basic earnings per share. Remember this point that the profit after tax will always be given to you in the examination. Preference dividend. So what preference dividend will show here? Remember this point that the preference dividend of irredeemable preference shares, because the dividend of the redeemable preference shares are already adjusted in the profit after tax. So when we talk about the preference shares means preference shares of an irredeemable share. Minus NCI will be used only when we are calculating the EPS of a group divided by weighted average ordinary shares. Weighted average ordinary shares means that you need to proportionate the number of shares if the time period is less than 12 months. Like suppose if the company has issued ordinary shares on 1st January 5 lakh and part of the shares in 1st July 5 lakh. At the reporting date, we have in issue 1 million shares. But with reference to IS 38.3, 5 lakh will be counted as full, and this remaining 5 lakh will be used for the 6 months only. So the weighted average shares will be 7,60,000 in this case. So now, guys, please solve this question. Example 1. Okay, let's solve this question. The profit after tax for the company is 1200 divided by ordinary shares of 6000. That was issued on 1st January, so it will be counted at full. And further, company has issued 1500,000 at full market price. So if it is on the full market price, then that it means that you only need to apply the time apportionment. This will be 9 upon 12. So the EPS figure should be, let me calculate, 1500 multiplied by 9 divided by 12 plus 6000 divided by 7125. So it will be 16.8 cents. So students who are the previous sessions recording available? If yes, how can we access it? It's available on the Vimeo on ACCA Pakistan page. You just write ACCFR on the Vimeo, or you can send me the message on the WhatsApp. I will share the recording with you. So previously there was some students who were calculating the EPS at 17.7 or 17. So that's what I wanted to know, that what mistakes they have done. So you should learn from the mistakes. We will solve the full past paper today. No, because we don't have the past papers available on the internet. It will be a hybrid paper of only section C. Now the second thing is the bonus shares. The company has issued the bonus shares. So whenever the company has issued the bonus shares, you need to calculate the bonus adjustment factor. Formula will be 1 plus bonus shares issued for one ordinary share. Remember this point, that the bonus shares will never be proportionated, and all you need to do is to multiply with the bonus adjustment factor for all the shares. So I want you guys to calculate the bonus adjustment factor for this question. Now the bonus adjustment factor for this question will be 1 plus bonus share issued for one ordinary share. So right now the company is issuing one share for every 4 bonus. Sorry. Right now the company is issuing one bonus for every 4 ordinary shares. So for each ordinary shares, company is going to issue bonus shares of 0.25. That could be calculated as 1 upon 4. So bonus adjustment factor will be 1.25. So you simply need to multiply while calculating the EPS. 1200 will be shown as on the numerator as earnings. In the denominator, company has got 6,000 shares, and bonus was issued on 1st April. So you don't need to multiply it with the time period. So since you simply need to multiply the shares outstanding with the bonus adjustment factor. So 5,000 shares into 1.25. It will be 7,500. So the EPS figure will be EPS will be 16 cents. Very good. Very good. One more question for you guys. Now, when you are calculating this EPS, you should keep this point in mind that you have divided the EPS by 1.25. Okay. So if in 2019 and 2020, actually the bonus shares were issued free of cost. That's why it will not going to affect the investment and the profits of the business, but it do affect the denominator of the EPS. So that's why the EPS will go down because of the bonus shares. So if 2019 EPS is 10 cents and in 2020 it is 8 cents, you cannot say that 2020's performance is poor on the basis of the fact that you have issued bonus share in the current year. So that's the reason the 2019 and 20 data are not comparable. So what ISRC says that you need to restate the previous year's EPS. So restated EPS can be calculated as the previous EPS divided by bonus adjustment factor. This is called the restated EPS because you need to compare the EPS and you need to compare the current year's EPS with the previous year's EPS. For this, the policies and the procedures must be same. So you simply need to divide the previous year's EPS with the bonus adjustment factor. So that's why we are attempting note question number 3. It says the previous year's EPS is 18 cents already. So previous year's EPS should be divided by the WF in order to calculate the comparable EPS. So 18 divided by 1.25. So it will be 14.4. Is it clear? Wonderful. Can you repeat the reason for the revised EPS? We used to calculate the revised EPS because of the fact that bonus ultimately decrease the EPS. So if in the current year company has issued the EPS and your EPS is having a different value, so this EPS and the EPS of the previous year it is not comparable because of the fact that previously we don't have the bonus issue and right now we have the bonus issue. Now please solve this question. Now this part is related to the right shares. In the right shares, you also need to calculate the bonus adjustment factor, which will be based on the market value divided by average value. Average value is also called theoretical X right price. And market value is also called actual cum right price. Please start to solve this question. The question is, what is right shares? Right shares means the shares which is issued to the existing shareholders at lower than the market value. Now, TRP means the theoretical exercise price. Now, the company has issued one right share for every 4 share held. So previously, if you have got 4 shares, you will get one right share. And you have got 4 shares at a market value of 4. So the value will be 16. And you have got one right share at a value of 2.5. Value will be 2.5. So finally, you have got 5 shares at a price of 18.5. So when you calculate the average value, which is called theoretical exercise price, which will be 18.5 divided by 5. So it is the on average per share value. So on average per share value is 3.7. So the bonus adjustment factor will be 4 divided by 3.7. So now remember this point, that this factor will be applied on the shares before the issue of right share. So right shares is actually issued to the existing shareholders, but at a price which is lower than the market value. Now let's solve this question. The earnings is 1200, and at the start of the year we have got 6000 shares. So first you need to proportionate these shares up to the date of right. So right was issued on 1st April. So from 1st January to 1st April there will be 3 months. 3 by 12 into 1.08. So this is the bonus adjustment that we made on the shares before the issue of right shares. So the total number of shares after the issue of right shares will be 7,500 into remaining life time period of 9/12. This is how we can calculate the EPS. All the 4 days are updated uploaded on the Vimeo site. So the EPS figure will be 16.56. Very good. Now, if the examiner gave you 2002 EPS, that's the EPS that you have calculated for 2003. So if the examiner gave you 2002 EPS, which is assuming it's 18 cents, then you need to restate this EPS by dividing it with the BF. And this will be the restated EPS. So 18 divided by 1.08. So it will be 16.67. Where did we use 18 from? Actually, I was just sharing a value of the EPS with the assumption that it was been given to us for the last year. Cannot go in too much detail because we have lots of assignments to do. I want you guys to do this question again. This one. Okay, it's done already. My example and the next example is approximately same. Okay. Now let's solve example number 6. Now we are going to start the area which is related to diluted EPS. When we talk about the diluted EPS, the basic formula will be same: earnings divided by weighted average shares plus notional savings divided by notional shares. Notional savings divided by notional shares. Notional savings means that whenever notional means assume figures, that whenever we are going to adjust the diluted EPS, you need to assume that the potential ordinary shares being converted into ordinary shares. Like the first one is the convertible. Convertible means convertible loans, the loan which can be converted into ordinary shares. So we are assuming here that the time that the loan was issued has been converted into ordinary shares. So if the loan was converted into ordinary shares, there will be a saving. And what amount will save? That is the interest amount. So our interest into 1 minus tax rate will be saved. With respect to notional shares, you need to take the maximum shares at the time of conversion. I request you guys to calculate the notional savings and notional shares for this question. Now the notional savings will be interest of the loan. The loan is having a value of $5,000 and its effective rate is interest rate is 10%. So there will be an interest of 500 and 1 minus tax rate means you need to take the 70% of the interest cost, which is 3. With respect to notional shares, you need to take the maximum number of shares that the convertible loan instrument can be used. So here we have got the value of the loan, which is 1,000, and each 100 loan can be converted into 60 ordinary shares, which will be 3,000. So when we place these figures on this formula, the earnings is the same, plus notional saving is 350. In the denominator, we have got the 6,000 number of shares plus notional shares is 3,000. Now you will be able to calculate the EPS diluted. 17.2 cents. Now, based on this information, the EPS will be 17.2 cents. The EPS will be 17.2 cents. Now, this question is related to options. This is again called the potential ordinary shares because the option can be converted into ordinary shares. So, notional savings, notional savings will be zero. Notional shares will be free shares. So in this case, notional savings is zero and notional shares will be free shares. Free shares means you need to compare the option value with the market value in order to calculate the free shares. Now let's solve this question. Through the options company has issued 2,000 shares, and these shares are exercisable at a value of 1.2. At an investment of 2,400, you got the value of 2,000 shares. But when we divide this 2,400 by 1.5, you will get the number of shares that you will get at the market rate. 2,400 divided by 1.5. 2,400 divided by 15, 1.5, you will get 1,600 shares just because of right share you are getting 4,000 shares. So the free share will be 400. So the diluted EPS will be calculated as 1,200 divided by number of shares into 1,200 divided by 6,000 plus free shares is 400. So the EPS will be 18.75. So 100 is the free shares that you get. Is it done? I didn't get the question. Please do ask again. Clarify on. Now, actually, company has got 2,000 options, but for each options, company has to pay 1.2 per share to get number of shares. The company has got 2,000 number of shares at a value of 2,400. 2400 is the price, and company has got 2000 shares at a price of 2400. But if we divide the market value with the number of shares, with the market value of the shares, if you divide the investment with the market value of shares, so based on the market value, you will get 1600 shares at a price of 2400. So with respect to the market value, you should get 1600 shares. But because of the option, you are getting 2000 shares. So how many shares you will get free of cost? Which is 400. Is it clear now? Okay. Now let's start with the new topic. This part is related to IS 40. IS 40 applies to all type of land and building that we acquired with the intention of future rentals or capital appreciation. So actually, if you have done the investment in the property means land and building, and your objective is to earn rentals or to make the capital appreciation, this is called investment property. Okay. Investment property can be measured at cost model or fair value model. The cost model is similar to IS 16, but the fair value means you need to measure at each reporting date. So you need to do this exercise on annual basis. Then the gains or the losses that arises during this period will go in the income statement, and no depreciation will be charged on the assets which are measured at fair value. And the exam question of this standard is like this. Like we have got the investment property having a value of 10 million at start, and now it's 9.8 million. So there will be a loss of 0.2 million. The accounting entry for this loss should be debit credit investment property credit by 0.82 and income statement debit by 0.2. That's it. So you don't need to charge a depreciation. And the question clearly says that the company has adopted the fair value method for investment properties. So these are some key points of IS 40. IP means investment property. Now, the second thing that we need to discuss today is IFRS 16. Now, IFRS 16 is a short-term lease. It's taken under, yeah, short-term lease if it is related to land and building. Okay. One of the student is asking for, I come across certain questions regarding it changes from IS 16 to 40. Okay, remember this point that there is a MCQ that examiner usually asks about the IS 40 is if previously we have got the property like land or building, the main intention is to get the rentals or to get the capital appreciation. But after some time, the company has decided to use this property into their business. So if the company is going to use this property into the business, then it will be applied under the scope of IS 16. So when you change the intention, the provision of the standard will be changed. So if the property is investment property, then it will be dealt with under IS 40. But if the property is related to uh, use into the business, then it will be considered as under IS 16. Now, if this property is being shifted from 1640 to 60, so the question that where the gain or loss will go at the time of transfer. Base, the base accounting standard is IS 40. Therefore, the gain or loss at the time of the transfer will go in the income statement. But if the property is moving from this in this direction from 16 to IS 40, then the gain will go in the revaluation reserve. Okay. So if there is a loss, then you need to see whether there is a balance in the revaluation surplus. The answer is yes, then it will go in the revaluation. Otherwise, the loss will be shared in the income statement. Now, IFRS 16. IFRS 16 says that you need to follow one model, that is the right to use the model. Like previously in an IS 16, we have got accounting for two types of leases. The first one is the operating lease. The second one is the finance lease. But now we have got only one type of lease, that is the right to use model, in which we need to record the asset and the liability at the same time, and this liability will then be amortized as we have discussed in our day 3 video lecture in IS study 2. So it's a very simple way, and there is a area of sale and leaseback that will be discussed later on. But you should remember this point, that IFRS 16 will not be applied on the lease agreements less than 12 months and low value items. Now here's a question for you guys. Please solve it. Please solve this question. Now, first you need to make an accounting entry. We're debiting the asset and crediting the lease obligation. So, as we don't have any down payment, then there will be no cash at the time of getting the lease asset. The liability should be recorded at the present value of the future lease payments, and then asset will be recognized at the same time. So now this asset now will be depreciated as normal, and this will be amortized. Now it says that you need to make the table for the payments in advance case. So if the payment was made in advance, then first you need to make the obligation at start, then we have to make the payment first, and then we will charge interest, and there will be obligation at end. So in the year one, the obligation at start is 7,50,000. Implicit interest rate is 10%. So it will be sorry, first you need to make the payments. The payments for each year is 215,000, and then interest will be charged at 10%. So first you need to deduct installment because it's being paid in advance, and then you need to charge interest. It should be 53,500. And my obligation at end will be 750 minus 215, 588, 500. So this amount will go in the income statement as a finance cost, and this amount should be broken down into current and non-current liability. So out of this amount, company is going to make further future payment of 215,000. So you need to deduct this amount, and there will be payment of 373,500 for non-current liability. I hope that's clear. Current liability in case of advance payment will be the installment amount. So out of 588, 500, you are going to make 215,000 and then in the next year. So whatever liability will be settled in the next year will be reported as current liability. And the remaining amount after deducting the current liability will be the non-current liability. Okay, is it clear? Now the second thing is to depreciate this asset. So whenever you are going to depreciate this asset, the formula is the cost of the asset divided by lease period of useful life, whichever is lower. The equipment has got the useful life of 4 years and the lease period is also 4 years. So you can take the 4 years, but if the values are different between the useful life and the lease period, then you need to take the lower amount. So it's 187 7,500. So there are a few questions from the student side. Sometimes we have to less the initial cost. Initial cost, no. Initial cost or issue cost is deducted only when you are talking about the issue cost of the loan. Under IAS 32. So in question they said the 4 annual payments. So it should not it be 215 into 4. 215 into 4 means I didn't get the question. Yeah, if this is the area question, actually there is no issue cost of the lease. That's why we don't need to deduct anything from here. Now, we are going to solve this question in which we will be giving the payment terms is in areas. So there will be a change only in the table that initially you have got the obligation at end. Now in this question, first you need to charge the interest and then we will make the payments. This is called the obligation at end. Now let's solve this question. First, you need to capitalize, make the accounting entry by debiting the asset and crediting the lease obligation. Present value of the lease payment is 31,552, and the dynamic incurred initial direct cost of 3,000. So this will be paid in the form of cash, 3,000. So the total asset will be reported at 34,552. Okay. Now, first, the obligation at the start of the period is 31,552. Then interest will be paid based on 5%. Three one double five two to 0.05, 1578. Payment will be 10,000. And the obligation at end will be 31,552 or 1578 minus 10,000. So it will be 23,130. So the difference between the advance payment and the arrears will be, in case of arrears, you need to make the table for the 2 years. So it's 23,130 into 0.05. So the amount would be 1156. Again, the payment will be 10,000. So the obligation at end will be 23,130 plus 1156 minus 10,000. So this amount will be 14,286. So now you will be in a position to calculate the current liability and non-current liability. The non-current liability based on the year one is 14,286. And the current liability is the amount that you have paid between the 2 years. It will be 88,444. Depreciation will be based on 34552 divided by lease period and useful life, whichever is lower. So we don't have any useful life in this question. Yeah, it's 3 years actually. So 34552 divided by 3 years. The depreciation will be 11,517. Is it clear? So the finance cost will be this amount, which is 11,1578. So it's very simple to calculate the current and non-current liability, but by just making of second year's table. So based on the year one, if you are paying something between the year one and two, this will be your current liability. So you need to take the difference between 2 years, and whatever amount that was outstanding even after the second year will be your non-current liability. I hope this point is clear now. Shouldn't we include 3,000 in the current in the lease liability? No. 11517. Yes, this will be the depreciation expense cost. It will not be uh, charged in the finance cost. It is a part of the cost of goods sold. Yes. So it's a treatment for the areas. In case of advance, you only make to make table of amortization table of for the first year, and the installment amount is the current liability, and the remaining amount will be the non-current liability. Suppose if the useful life is 10 years and the lease period is 5 years. So how we can depreciate and the asset, the cost of the asset is 5 lakh. So what will be the depreciation of the asset according to IFRS 16? Yes, if the useful life is 10 years and the lease period is 5 years, the depreciation will be according to IFRS 16 that you need to take the useful life or the lease period whichever is lower in order to calculate depreciation. So the lower amount is 5, so depreciation should be 100,000. But if it is mentioned in the question that the useful life, that the legal title of the asset will be transferred to the lessee at the end of the lease period. If it is mentioned that the legal title of the asset will be transferred to the lessee at the end of the lease period, then asset will always be depreciated at its useful life. So in that case, you need to charge a depreciation at 500,000 divided by 10. If it is certain that the asset will be transferred at the end of the lease term, then it will be depreciated on the useful life. Very good. Absolutely right. So now let's take a break of 10 minutes, and after that we will start again. If there's an option transferred and it is probable that the company will exercise the option, then you need to take the useful life. Candidates, are you hearing my voice? Yes. Okay. Okay. So I have started the topic sale and lease back. I think we need to restart this topic again. Sale and lease back is an arrangement in which we sold the asset first to someone like Mr. A and then lease it back. In this arrangement, first you need to identify whether the transfer is a sale or the transfer is not a sale. So you need to identify whether the transfer is a sale in this situation or transfer is not a sale. So I'm giving you an example. Suppose if the useful life of the asset is 10 years, but we have taken this asset on lease terms for a period of 2 years. So if the useful life is 10 years and the lease period is 2 years, so what do you think? Whether this transfer is a sale or this transfer is not a sale? The transfer is a sale because we have sold this asset to A. So who will ultimately use the asset for a longer period? So is it us or is it A? So actually we have sold the asset having a useful life of 10 years, but we have only borrowed this asset for 2 years. So after 2 years we need to return this asset to Mr. A. So it was actually Mr. A who is enjoying the whole life of the asset. So that's why you can say this transfer is the same. But if the lease period is also 10 years, then what does it mean? That we have sold the asset to Mr. A having a useful life of 10 years, but we lease it back for a period of 10 years. So now in this situation, who is enjoying the whole life of the asset? It's actually the seller. So actually we have sold the asset, but lease it back with the same lease period as the useful life of the asset. So it means that effectively the control of the asset is still left with the seller. So that's why we can say that you have sold the asset apparently, but this transfer of this asset is not a sale transaction. Is it clear to you guys? Yes. Wonderful. Yes. When the seller enjoys the useful life, whole useful life of the asset, then the transfer is not a sale. Now, what you need to do when the transfer is not a sale. So it says that continuing recognizing the asset and recognize the financial liability equal to the sale proceeds. Suppose in our books of accounts, the carrying value is of the asset is 10 million, and we have sold this asset for 15 million. Normally, when we sold non-current assets, the accounting entry will be cash debit by 15 million, asset credit by 10 million, and gain credit by 5 million. So this is the normal treatment when we sold the asset to someone. Now, in this situation, if the transfer is not a sale, it says that you need to recognize the asset. So in place of de-recognizing the asset, de-recognizing means that you are going to credit the asset in the books because you have lost the control of the asset. So that's why we are crediting the asset and recognizing a gain. So standard says that in place of this accounting entry, what you need to do is to continue recognizing the asset in your books of accounts, and whatever cash that you have received will be recognized as a loan. The accounting entry should be cash debit and loan credit. The carrying amount of the asset which is still remain on the face of the balance sheet. You cannot de-recognize the asset. Yes, definitely when you have recognized the liability, then you also need to book the finance cost of this liability. Now, when in the situation it says that transfer is a sale, that means that you have lost the control. So that is called de-recognition. So you need to de-recognize the assets from the books. So what it says? So first you need to make the accounting entry for the normal sale like cash debit, asset credit, and gain credit in the income statement. That's the normal accounting entry. Transfer means we are going to sell the asset. So we are selling, but whether this transfer and selling the asset is actual sales or not, that's what we are discussing here. So we have sold the asset. So the accounting entry should be cash debit, asset credit, and gain credit. But at the same time, we have leased it back for some time period. So apparently, we have sold the asset, but we have leased it back for some time period. So in that case, your accounting entry will be right to use the asset debit and lease obligation credit. So there will be a combined entry for the sale and lease back when the transfer is not a sale. So actually there are two entries which we have recorded simultaneously. Now we need to do the depreciation based on the asset that we have recognized. Is it clear to all of you? Now let's start solving this question. It is related to the past papers. So we have acquired the asset on 1st April, and you need to calculate that what is the total amount that should be charged the profit loss. So when we talk about the income statement, profit loss, there will be two items. The first one is the finance cost, and the second one is the depreciation. Remember this point that we have acquired the asset on 1st April. So from 1st April to December, we need to book the finance cost for a period of 9 months, and depreciation also for the period of 9 months. Yeah, we have to do the depreciation and the lease back situation as well. Yes. Please calculate your answers. The exam based question. We need to report. We need to report the depreciation and the finance cost both. Is it B or D? I think it should be D. Very good. So you need to check the time period after which you guys are attempting a particular question of the past paper. So the time period should be not more than 2 minutes. Wonderful. Now what about this one? Again, the question is related to the total charge to the profit and loss. That means you need to add both the depreciation and the finance cost. Remember this point that we have acquired the asset on 1st July 2004 and the year end is 30th June. So the time period is very important for all the questions. It's very good. The right answer is B. Yes. Yes, attributable cost will be added. When calculate the right use the asset, should we have to deduct the annual payments? No. Annual payments is related to the lease obligation. Okay, so some of the students want me to solve this question. The first accounting entry will be asset debit, lease obligation credit, and cash credit. Lease obligation is 4657,500. The attributable amount is 37,500. The asset will be reported at by adding this figure. 4695,000. 4695. So now, first of all, you need to charge the depreciation. So it will be an 8 years lease agreement. The depreciation will be 4695,000 divided by 8. There's depreciation that we need to charge. And for the lease obligation, we need to make a table. Obligation at start will be 4657,500. And the company is paying the interest in areas installments. First, you need to charge the interest at 6%. The payment of 7,40,050. So the depreciation amount will be 58,687. Now, what about the interest cost? 279. So the right answer for this is B. By adding these two figures, this one and this one. We never recognize the direct cost in the liability. So right now it's 10:46. Question: why does the useful life? When you see the question, you will find the useful life is here. Okay, so now it's 10:45. I request you guys to stop me after 15 minutes. So we are starting the standards because from 11 a.m. we'll start working on the ratio stuff. Let's start. I said about the accounting policy, accounting estimates, and correction of errors. For accounting policy, it says that you need to follow and apply the policy consistently. So policy should be followed with consistency, and if there is a change in the policy, then it will be applied retrospectively. Retrospective means adjustment will be required in the opening balance of retained earnings and comparative information. Accounting policy can only be changed when there is a change in IFRS, change in change in management's perception. Management perception that the new policy is more reliable and relevant. So the basic thing is you cannot change the policy and it should be applied consistently. When you are going to change, it can be changed according to IS 8. It says that you can only change the accounting policy when there is a change in IFRS or change in the management perception about the policy. Similar sort of treatment will be made for all the material errors is that comparative figures. The whole P&L and balance sheet needs the previous year's data. Material errors, if it is done with intention, it is called fraud, or it was done by the mistake, that will be a mistake. So the errors of the fraud, if identified and having a material value, will also be adjusted retrospectively. Yes, you can find a sum where you need to adjust the opening balance of retained earnings. That will be mostly related to the frauds. It's not about the accounting policy. It will be based on the fraud. Otherwise, the rest of the item will be asked in practical aspects. Accounting estimates are adjustments in the carrying amount of an asset or a liability. Accounting estimates, whenever we have got the accounting estimates, it must be reviewed annually. Reviewed annually. And if there is a change, it will be applied prospectively. Prospective means the adjustment will be made in the current period and future periods, but not in the previous years. There's a question for you guys. I want all of you to please do attempt it. You have 1 minute for this. It's wonderful. There is a fraud that has occurred during the year that the receivable figure was stolen by some of the directors having a value of $700,000. The accounting entry will be receivables credited by 7 lakh. The above charges had been stolen by the employee. 450 of this rental will be related to the year ended 31st March 2005. So these are previous years rental which should be adjusted against the previous year's rental. And in the income statement, there is a difference of 2 lakh. This amount should be adjusted against the opening values of retained earnings. Is it clear? Now the directors are hopeful that 50% of the losses can be recovered. So this amount can only be recognized when the chances of the recovery is virtually certain. Now please solve this question. Please solve this question. Now the right answer for this question is A. Is it clear? Okay, wonderful. Now it's 11. We need to start the new area. That is ratios. How? Okay. Revising the remaining useful life of the asset is an accounting estimate. And this question is asking for the accounting policy. Changing the value of the subsidies inventory in line with the group policy is consolidated adjustment. It's not a policy. It's just a consolidated adjustments. Switching purchasing plant using the finance lease from the previous. So it is not an accounting policy. It is an operating policy. That you wanted to buy the assets on cash terms or credit terms. So this one is the only policy that previously you were recording the commission income in the operating income. Now you are going to record this income as your revenue. So this is actually AE means accounting estimates. It's done. Last time that you said that the commission income cannot be classified as the revenue. It depends on whether you are earning the commission and it's your main business. Because when we talk about the revenue, revenue means the amount of the revenue that you are earning from your main business. So if it is your prime business, then commission will be your revenue. So now moving towards topic that is related to the ratios. So in the ratios question, you need to develop 3 skills. The first one is you should know the formula for the ratios. You should know the reason for the movements. And the third one is you need to incorporate the hint which is available in the ratio. So these are the 3 skills. If you develop these 3 skills, you will get 100% marks. Most of the students got confused in the ratios because of the fact that whenever you write your own answer and match with the answer of the examiner, so you will find a huge difference. So that is just an expectation gap. Remember this point that examiner is a qualified person. He has got number of years of experience. So the interpretation that he writes will not be possible for you as a student to write in the examination. So you don't need to worry about the comments that was written in the past papers or the examination case. So you only need to see whether the formula is correct, whether you have given the right reason, and whether you have incorporated the hint available in the question. So when you are reading the question, your answer with the examiner's answer, you only need to see these 3 items. Secondly, it's not possible that your answer and the exam kit answer will be 100% matched. It's not numbers actually. It's not a number game. Like you have calculated the goodwill having a value of 10,000. When you go back and check the answer, it will be 10,000. So you are used to of matching the 100% answer, but for ratios question, it's not possible. So here are some issues that was identified by the examiner. The first one is the limited knowledge of the ratios calculation. Appraisal not linked to the scenario. That means the hint was not being incorporated. Limited understanding of the what accounting information represents. Lack of commercial awareness like business sense. Inability to come to the conclusion. And the last but not the least, the poor English. So these are the factors that you should keep keep these points in your mind before preparing for the ratios. And it's highly recommended to read 2 articles that is available in the FR study resources of ACCA website, where you will learn how to write the answer. And then when you are going to do the practice, select 2 questions from the latest past papers. 2 for single company, 2 for group of companies. And it's better to take the past papers of most recent attempt. Don't go in 2016 or 2000 even 15 and all. You can start with 2017 and a maximum 2018, 19, and 20. Even if you start from 2008, that will be totally fine. So you need to select 2 questions, one from the single company and one for the, yes, 4 questions is enough to practice the ratios question, but you need to write your answer on the Word document so that you can check your typing speed. Remember this point that you will not be given an Excel sheet in the examination pass in the paper. So you need to calculate the ratios on the Word document. Now, so in most of the comments, we always start with the profitability, and the profitability, the first ratio for the profitability is the ROC. Remember this point that ROC is dependent on profit margins and asset turnover. So if the ROC has improved over the year, 1 or 2 is responsible for this movement. It might be a profit margins or it might be asset turnover ratio. These 2 or anyone is responsible for the increase or decrease in the ROC. And what does ROC shows? It shows that how well a business generates profits from its long-term financing. So you can also drive your definition based on this formula. So whatever we have in the denominator will be the base, and we are measuring the performance of the numerator. So we need to check in this question, in this formula, that how much profit the company is generating in comparison with the resources or the capital that we have employed. It's normal to take the profit before interest and tax, but examiner might ask you in the question to take the profit before tax. But for ROC, we never use profit after tax. Profit after tax will be used for the calculation of return on shareholders' equity. That is ROSE. And profit after tax minus preference dividend will be used for return on owner's equity, that is ROE. Now, so remember this point that you only or you always have to start from the ROC, and you have to make the responsibility for the movement to a profit margin and asset turnover. Then you should shift towards the asset turnover, which is based on the revenue divided by capital employed. So you are now in here. You wanted to see the revenue that you are generating based on the investment that you have made in the company. So it just shows us how efficiently management have utilized the assets to generate the revenue. So actually, it was measuring the management's performance to improve the efficiency of the resources. Now, what are the factors that affects the asset turnover? The factor that might affect the asset turnover will be if there is an increase in asset turnover. The reason will be might be a increase in revenue, or decrease in the capital employed, or vice versa. When there is a reduction in the asset turnover, that means there will be a decrease in the revenue, increase in the capital employed. So these are the reasons that you need to mention. Now, then we have gross profit and operating profit. Gross profit measures the performance of the business at the trading level, like how much profits that we are gaining from the products or services. Yes, actually, the ratio has got the direct relation with the numerator. So if the denominator increases, the ratio will be decreased because they have got the inverse relation. Now, typical variation in the ratios are a result of the change in the selling price. If the gross profit ratio is changing, the reason could be due to the selling price, volume, or changing the cost of sales. Analyzing the operating profit margin enables you to determine how well the business has managed its and controlled its indirect costs. And that's the point of calculating the operating profit. We need to see that whether, sorry, we need to see whether your expenses or indirect costs are controlled or not. So when we are talking about the operating profit, it's better to link the answer with the gross profit, because if the operating profit margin is increasing, then definitely there must be an increase in the gross profit. The gross profit, operating profit is derived from the gross profit. So if it is increasing, then it will be a positive impact on the operating profit as well. And if there is a change in the operating profit, it might be due to good direct, indirect control, and there could be a one-off profits, like there might be a gain on disposal that boosts the profits. So if the item anything is one-off, not recurring, then you need to highlight that point in your negotiation skills. Deteriorated means that uh, has destroyed, something is destroyed, or something is actually going on the wrong side, or the something which is bad for the business. Now here's a question for you guys. Is it done? Now what's the answer for this question? Which of the following current year event could explain a fall in the operating profit margins compared to the previous year? So the profit figures is decreasing. A change of from the amortization of the development cost being included in the cost of sales and of being included in the administration expense. This is not going to affect the operating profit. This is actually adjustment of the gross profit. A decision to value the inventory on the average cost basis from the first in first out. So you are moving from first in first out to weighted average. So you should know this point in mind that in times of rising prices, FIFO will give the maximum profit. And if you are moving from FIFO to weighted average, then definitely it will reduces your profits. When there is a reduction in the allowance for the receivable, it will increase the profits. Increase in the gearing, it will affect the profit before tax. So the right answer for this question is C. Now it's about the current ratio. Current ratio and quick ratio both are the ratios of the liquidity. If they both are increasing, that means the liquidity position is good to a certain extent. And if they both are decreasing, that means the business is managing its liquidity position. But you need to see whether the decrease in the current and the quick ratio is avoidable or acceptable or not. If the decrease is not acceptable, that means the business is having a serious liquidity problem which can affect its going concern as well. Similarly, if there is a substantial increase in the current and quick ratio as compared to the previous year or industry average, then it means it's a misuse of assets. Talking about the receivable turnover, if the liquidity position is worsening, means that business is having a serious liquidity position problem, which might affect the going concern of the business. Now, receivable collection period, payables collection period, and inventory turnover in days. So these are the three things. The time period is increasing for these two things. This will be considered as a negative point for the business. And if it is reducing, that will be considered as a positive point. Whereas if the time period is increasing, it will be considered a positive point and negative. That's the general perception. Now, if the receivable turnover in days period has increased over the period, then you need to see the reason behind this. So increasing days means increasing receivables. So one of the reasons could be the company is not writing off its old debtors, or the company has increased its credit period to the customers. There might be an additional company that you have bought during the year whose receivables figure and the credit period or the policies is different from the rest of the other members, then it will affect the receivable turnover in days. Then we have a payable payment period. If the payment period is increasing, then that will be considered as a good for the company because it's a free source of finance. But you need to see whether it should not be going to affect your terms with the supplier, because if supplier has stopped providing you the material or working as a vendor, then it will affect your business as well. Sometimes there might be an area of early settlement discount. So if your payable payment period is decreasing, that means that you are getting early settlement discount. It depends, is it good for the company or not? It depends on the situation. Sometimes it's good to need to maintain a liquidity position. That's why you can see that there are a number of brands who are offering discounts to their customers on different occasions in order to maintain its liquidity position. And they were actually compromising the profitability. So it depends on the business current position and business objective of offering the discount to customers. But you should know this, that if the payment period has increased or decreased, then you should know the reason for this. The most important point in the ratio analysis that is that you should know what are the items that distort the comparison, that affects the comparison. So it will be anything which was not present in the previous year but present in the current year, or vice versa. So if the 2 years or two companies are not comparable because they don't have similar policies or similar treatments, then these are the things that can distort the comparison. Similarly, one-off items will definitely affect the comparison. So you have to identify in the scenario that what are where are the hints that is affecting the comparison of the business. Now, debt equity ratio, the two formulas that we usually use: debt upon equity and debt upon debt plus equity. Examiner will tell you about in the examination that which ratio, which formula you should use to calculate the gearing ratio. Remember this point that gearing is good for the company to a certain extent, but when it is increasing, it will increase the finance cost of the business. That is the fixed cost. So if the finance cost is increasing, that will reduce the profits for the shareholders. If the profit is decreasing, that means it will be affecting the earnings per share as well. And if the earnings per share is decreasing, it will be affecting the share price as well. The ultimate sufferer will be the shareholder in terms of reducing the share price. Secondly, if the profit is decreasing, there will be a decrease in the dividend over the period. So that is again affecting the shareholder sentiments. So if the examiner does not specify the formula, it's better to use debt equity ratio. Similarly, if the company has got the debt, they need to repay the finance cost and the repayment of the loan. So if the repayment is closed, then you need to see the liquidity position of the business. If the liquidity is poor, that means business is facing a going concern issue. And you have to pay the fixed cost, finance cost, and the loan amount of, and you don't have the sufficient cash flow to pay off your debts, then it will affect. If the things gone worse, then it will affect the going concern of the business. Now, please do attempt this question. This question is about gearing. The formula is debt upon debt plus equity. Which of the following transactions would increase adjacent gearing? If you wanted to check the increase in the gearing, so there must be an increase in the denominator or decrease in the numerator. So increase in the numerator or decrease in the denominator. Okay. During the year, the property was revalued upward by 20,000. So if the property was upward, there will be a reduction in the gearing. A bonus issue of shares of 1 for 4 during the year. Remember this point that bonus issue is not going to affect the equity at all. Provision for the estimated damages was reduced during the year from 21,000 to 15,000 based on the most recent legal advice. So if the provision was decreased over the year, the accounting entry will be provision debit and income statement credit. It is actually increasing the profits, increasing the retained earnings, and increasing the equity. If the equity has increased over the period, the gearing ratio will go down. An asset with a fair value of 25,000 was acquired under finance. So finance lease means that you have acquired the asset on lease terms. Entry will be asset debit and lease obligation credit. So when there is an increase in the lease obligation, that means there is an increase in the debt. So when the debt has increased, then definitely it will going to affect the gearing as well. So the right answer will be D. Now one more question for you guys. The last one. So this topic is again important for section A and B as well. Which of the following are likely to decrease due to a significant revaluation gain? When there is a revaluation gain, the entry will be asset debit, revaluation reserve credit. Revaluation reserve increases means there will be an increase in the equity. When there is an increase in equity, all types of ratio in which where the in the denominator equity is present in the denominator, as it increases, it will affect the overall ratio. So ROC will decrease, gearing will decrease, and net asset turnover will also decrease. The answer should be operating profit margins. Yes, it will also decrease because it has a debit side as well. Because as the asset increases, it will increase the depreciation expense as well. which will affect the profitability, and the profit decrease in the profitability will affect the operating profit margin. The right answer will be A. Is it clear to all of you? Now, so that's the end of this session, practice to pass session. I hope you have enjoyed the session and learned something from me. And honestly speaking, I wanted to teach you a lot of things. And by tomorrow, how does it going to affect the profit margins? Because when we uh, book the upward revaluation or gain on the revaluation, there will be a corresponding entry in the asset account. And as the value of the asset increases, it increases the depreciation expense as well. So when it increases the depreciation expense, it will definitely affect the profits. So for those who will not be able to see all my videos, I request them to take and listen my videos as much as you can, along with benchmark questions, which I will share with you guys tonight. As ACC allows us only 15 hours for delivering this cash practice session. Otherwise, we can have a lot of things to learn, but in a very limited time period, I have tried my best to deliver the best content. So the benchmark questions will be shared with you guys. Then you need to follow the plan in which you have to attempt at least 4 mock exams. So from 1st of June, I will share the mock exams. Then there are students who wanted me to share the slides for day 4 and 5. I will share on the group as well. So if there are some students who haven't joined the group till date, I request them to join the group so that we can have a discussion. If you want my support, you can send me the message directly on my WhatsApp, or we can have a Zoom meeting as well if you wanted to learn something from me. Today is 28th of May. My date of birthday. You have 29th, 30th, and 31st. You still have 3 days in the month of May, and you have almost 1 week in the month of June. So almost you have 10 days. So do not spend your time on any other activity except this paper FR. If you are a working student, I recommend you to just send an application to your employer and take leaves for at least 7 to 8 days for the preparation of this paper. Otherwise, you will not be able to pass the paper, because this time is very crucial. If you spend this time in sleeping and talking with your friends and doing some other activities and enjoying your weekends or working for your employer, believe me, you will not be able to pass the paper, because the percentage is 50%, not more than that. So there are 50% of students who have to fail. So you have to make sure this that out from these 10 days, you should pass your papers and make yourself in those students who are going to pass in discipline. Believe me, his employer is least interested in your career. You have to make your own career. So it's better to avoid all the things. Leave your mobile, cell phones, leave any activity that is non-valuating in your life. Just ignore that activities and focus fully on this paper. This paper needs, if you have prepared for the P2P, this paper only needs your attention and focus and attempt the mock exams and follow my special plans. I can give you the guarantee that you can definitely pass the papers. So my best wishes for all of you. My employer can allow that. You have to take the decision. Or if it is not possible that you will not get the leave from the employer, then you can even take the half days from the employer. So I'm available for your support till the examination date, and the management will share my WhatsApp number with you guys. I request the management to please share the WhatsApp number. Thank you so much uh, for uh, giving your feedback about this session and wishing me a birthday. I I wish you best of luck for this paper and the next paper ahead. Are you charging for the Zoom meeting? No, it's not. It's free. I didn't charge anything because ACCA pays me for these sessions, so you don't need to worry about the charges. So thank you so much for your time, and we will discuss further on the WhatsApp group. Take care. Bye bye. Love.